So one more thing here. Okay. See if I can connect to Facebook really quick. Hold on a second. Resume. All right, here we go. All right, so welcome. Today is Thursday, 26th of August, 6:35 p.m. And sorry we're late. As I was telling Rudy, I lost the key to a house. That's like a rookie real estate mistake. It happens from time to time. I do have, believe it or not, a big stack of keys, big bag of keys at my house from like houses throughout the years that I just take home and I just forget which house it was. And anyhow, all right. So today we're going to be talking about buying real estate. So, you know, just a quick introduction before we start talking about the market. Real estate to me is super important. The reason why is because, you know, I've been doing this 19 years, and over the years, what I've realized was how much it's helped people, you know, and I have a lot of clients that own a lot of real estate. I have clients that are millionaires, decamillionaires, into hundreds of millions of dollars net worth, and real estate had a lot to do with it. And I have a bunch of smaller clients that, you know, are worth a few million, and they didn't even get into real estate as investors. You know, they accidentally became investors over time. So, and they started with their first home. They started with a small home, and then, or a condo, townhome, small home, and then they lived in it for a few years. And then they said, hey, okay, we're having a family. We're getting bigger. We need more space. We need an extra bedroom. We want a yard. And then some way, somehow, they just kind of qualified for the second loan. They ended up with the first property. They moved out. They turned it into a rental. And then they have the second property. And then a few years later, they go, oh, you know, the kids, I want them to go into a different school district, high school, whatever. And then they got their third property. They kept the first two, and then now they're like landlords. And then some of them ended up realizing that that was kind of like that was like actually pretty cool to do. So then they started doing it more and more and more over time. So the great thing about real estate is at the end of the day, it's a game, and you just have to know it's a game. Number one, be conscious that it is a game. Number two, know that there's rules to the game. Just like any other game, there's rules to it. And then number three, the most important thing is you have to actually play the game, right? Because a lot of people understand it's a game. A lot of people, not a lot of people, but some people know the rules of the game as far as financing and how often you can like change houses. So some people know the rules of the game, but most people never play the game, okay? And if they actually play the game, what they do is they just play the one move, which is buy their first home. But they never really make another move. They might make a second move, which is refinance, right? Because rates change, they drop, they want to get rid of mortgage insurance, and they say, okay, let me play my second move, which is refinance. And they play the second piece on their board, monopoly board. But then very few people start making the second, third, fourth, fifth, sixth, seventh, eighth move. So that's why I like real estate. Because I've seen it change a lot of people's lives, including my own. So the first thing we need to talk about is just the overall real estate market. That way everybody kind of understands that. So days on the market. This is San Diego County, by the way. I know you guys are joining us from Northern California, but in San Diego, just to get an idea, it takes 28 days to sell the average home, compared to last year it was 34 days, and that's super fast, by the way. If you look here, anything under 60 days is considered a hot seller's market. So in your area, if the homes are selling under 60 days, is considered a hot seller's market. So if it's taking 28 days to sell a home, that's a hot seller's market, like extremely on fire, right? Now, inventory levels right now are have been increasing. So in San Diego County, there's about 3,100 homes for sale. This is important to look at in your area as well. What's the inventory of homes? So right now there's 3,100 homes. Normal San Diego market is 6,000 to 8,000 homes for sale. That's a normal market, 6,000 to 8,000. So right now we're like half of a normal market in San Diego County. I know Riverside County is a lot hotter than San Diego. So there's less inventory up there. Orange County, similar. LA, similar. Now, 3,100 homes now, but 6 months ago, we were somewhere around 1,900 homes. So over the last 6 to 8 months, we've been gaining like 100 to 200 homes every couple of weeks. So the market's going up, right? Demand, we just lost about 1% over the last couple of weeks of buyers wanting to buy. And what I'm hearing a lot of is buyers saying, you know what, the market's too expensive. It's prices are too high. I'm gonna wait for them to drop. So we're getting a lot of that feedback. So buyers are dropping. So kind of, when you look at inventory and you look at demand, you wanna look at it kind of like this, right? You have this many buyers right now, and then this many homes. And then every week until the end of the year, what I think is gonna happen is we're gonna see more inventory, and we're gonna see a little bit less buyers. And then they're gonna kind of bridge the gap. I don't know if they're gonna bridge the gap all the way, I doubt it, but it's getting, the difference is getting closer, okay? So you wanna check in your specific area as to what's going on with how many homes in the market compared to the normal inventory over the years, over the last 20 years. And you want to look at the demand, how many buyers are there, right? But I'm sure, all California, most of it is on fire. Now, this is the beauty is interest rates. Interest rates are very, very low right now, historically low. So FHA, VA buyers, you guys could get 2.5% to 2.75% interest rate, which is amazing. It's lower than last year. Last year was 3.1%, same time last year. And then conventional loans, you could get 2.875%. So let's talk about interest rates. I know lenders that have been in the business for 30 years. And last year, what happened, and the reason why they're so low is because when the pandemic happened, the federal government didn't want like a halt of the economy. And the real estate business moves a big portion of the economy, right? Construction, whenever somebody buys a house, there's like 70 to 80 people that get paid on that transaction, from contractors to landscapers to escrow officers to title reps to real estate people to lenders. And the lenders is not just one, it's like there's processors, there's notaries, there's front end, there's back end. I mean, there's a lot of people, and that's the economy moves. So when the pandemic happened last year, the federal government kind of took charge, and they said, we're going to drop the rates to under 3%. That's the first time I've ever seen them in 19 years, under 3%. And the lenders that I know, they all basically said, I've never done a deal under 3%. So if you see the rates in the 2% range, guys, it's just unheard of, and you should take advantage of. So again, San Diego, the median price home, I know we have 986 here, but I think that's I don't think this is accurate. This is from one source that we have, but I think it's closer to 830,000. Vanessa could double check that. Last year, 675,000. So what we've seen is a jump in actual homes sold, about $130,000, $150,000 in appreciation over 12-month period. So that means if you own the home or you own real estate, you just made a lot of money without having to do anything. That's the beauty about real estate. Distressed homes. So this is something to look at. 15 properties in San Diego County that are distressed, that are either in foreclosure or short sale. That's not a lot of people. I mean, very few people are in trouble in all of San Diego County. So if you if your neighbors, if your friends, if your family are saying, don't buy now, market's going to drop, I highly doubt it, because when the market crashed in 2008, there was about 8,000 homes in distress. 8,000 in distress. Okay, someone's saying they can't see my screen. Good. Thank you for letting me know. There we go. So distressed homes, there's only 15 in all of San Diego County. When the market crashed last time, there was about 8,000 distressed homes. All right, new construction. So when the market crashed last time, there was about 16,000 new builds every year. So what happened? There was an oversupply of homes leading up to the crash, right? So we're building this home inventory. Next thing you know, we overbuilt. And that's the normal real estate cycle. When you overbuild and then prices just drop. This time around, last year in 2020 and this year, we're right around 6,000 homes for homes that were built, new construction. So as you can see, we're not overbuilt, not even close. San Diego County, we're negative 35,000 housing units. 35,000 housing units negative. So that means that if we had an extra 35,000 housing units right now, there'd be 35,000 families that would need those units. Another way to look at it is there's a lot of people right now that are living together. So there's like extended family members, there's roommates that if there was enough supply, they would go out there and create their own households.
Hey, Voltaire.
Yes.
I was actually checking on that median price. So the average priced home or that sold last was $956. So it dropped a little bit from $986 in 2021.
Oh, wow. So right now it is $956.
Yes, sir.
Wow, that's pretty incredible. That's the median price. Thank you for that information. Okay, so going back to the market, guys, I'm going to recap why I feel that the market is going to stay strong and be strong for the next several years, and why your neighbor and your tia and your cousin are wrong. The real estate market is not going to crash, and this is why. Inventory, we're 50% of what's normal. Interest rates, the lowest in recorded history. They've never been under 3%. Distressed homes, there's only 15 people that are in trouble in San Diego County, and all of San Diego County. New construction, we're only producing 6,000 homes per year right now of new inventory. When the last time it crashed, we were overproducing at 16,000 homes a year. And then we're negative 35,000 housing units. So none of these numbers actually show that there's going to be any crash or drop in prices. Any questions on the market? Anybody?
I got a question, Voltaire. I know this data is specific to San Diego, but when you're looking at like the demand and the well, I think the other one was inventory piece, is that information like that's public, or we have to work with the real estate agent in our territory to kind of be able to get some insight into that data?
Yeah, for sure. So it isn't public. It's usually published on like different newspapers. I get my information from an economist. All he does is like stats for real estate. So it's like a paid service that I have. An agent in your area might, so this is the thing. I've been doing real estate 19 years. These stats, I haven't been using all these years. I've only been using stats like this in the last like 5 or 6 years when I really started taking like, real estate to another level. So the average agent isn't going to know these stats. But I could hook you up with somebody in that area that knows their stuff inside and out. And then that way they could tell you, where you're at in your area as far as like the median price home. That's going to be like probably the easiest thing to figure out. The hard thing is going to be like what's going on with demand. Is it up or down? What's going on with inventory compared to like normal last 20 years, right? And then the average days on the market, that's easy to figure out too. And then the other hard part is distressed people. How many distressed families are in your county? And what county are you in?
We're in San Mateo County, but
San Mateo.
looking towards like Sacramento County.
Oh, okay, gotcha. Yeah, so and then also how many people are distressed, let's say in Sacramento County, and then new construction. So that's huge to look at too, right? So you should probably write down a list of the things that you should be looking at so you could determine how strong that market looks. And I'll go over it again, that way you can write it down. How many new home builds now or in the last 2 years you want to find out compared to 2003, 4, and 5 leading up to the crash in Sacramento, right? And if it looks something like this, that means it's a super strong market. Okay, and it's going to continue to be strong. The other thing is how many distressed home sellers there are in the county, and then you want to compare it to, again, right when the crash happened. So in 2008 and 2009 in San Diego County, there was 8,000 distressed homeowners. Right now, there's only 15. And then you want to look at the median price home, see what that's doing. Interest rates are the same everywhere. Demand, you want to look at what's going on with buyer demand. Is it up? Is it down? And then inventory. Now compared to, the normal market in Sacramento. Okay. So that's kind of the things that are important to see if it's a strong market and if it's going to continue to do well. All right. What other questions do we have? Let me just make sure Facebook, there's no questions on there.
And everything that Voltaire just mentioned, I threw into the chat as well. So if you didn't have a chance to handwrite that in, you can copy that off of the chat as well. Cool.
Thank you for doing that, Ro. All right. Yeah, thank you. So again, with the market, it's strong. I think it's going to continue to be strong. I'm buying as much real estate as I can right now. And the reason why I'm doing that is because I think we're going to look back 5 to 10 years from now and we're going to think, man, it was very inexpensive. Let me talk about what the market is doing right now as far as price, because everybody says, Voltaire, you're crazy, like super expensive right now. When we look at it in US dollars, because everything's priced in US dollars, it is expensive. It does take a lot of US dollars, like Raul told me right now, 950,000 US dollars to buy a medium price home in this county. That is a lot, but it doesn't mean that it's overpriced. Does that make sense? So it is expensive, but it's not overpriced. And what I mean by that is, right now it's the most affordable time in history to buy a home. When you compare the median mortgage payment that you have to make versus the median income, household income. So there's a lot of households right now, combined income, that are in the 6-figure range, right? So let's just pretend, easy numbers, your total household income is 10 grand a month, and your monthly mortgage payment, I'm seeing a lot of 3,500s, I'm seeing a lot of 3,700s, a lot of $4,000 a month mortgage payments. That's 35 to 45% of your total gross household income on a monthly basis. Historically, and I have clients that have bought homes in the 60s, 70s, 80s, and they tell me stories of how their monthly mortgage payments were like $150, $300. And I was, my first reaction was always like, wow, that must have been really easy. And they say, no, I used to have take up another job, 2 jobs per person. So it was hard because based on their medium or their monthly gross income, their mortgage payment was like 40 something percent of that, 41, 42, 43, 45% of their total monthly income. So it's super affordable right now when you look at it, when you start comparing it that way. And then, I'll take it one step further. It might be a little bit too advanced, but when you compare what it takes as far as other commodities to buy the median price home, when you compare it to gold, it's a lot cheaper right now to buy a house in gold than it was 20 years ago, 50 years ago. Same thing with oil. It takes a lot less oil to buy the median price home. So the reason why it seems expensive is because we're just looking at it from the scope of US dollars to buy the median price home. All right. Any other questions in regards to the market before we get into the good stuff? All right, so we'll get right into it. Let me pull this up. And maybe, let me make sure I have the most recent one. And I have one from 2020, actually. Claudia, do you have one? Here,
Yes,
I'm gonna have you, I'm gonna have you share your screen here. All right, there you go. Okay, so this is some information we're gonna share with you here. All right, so let's get into it. All right, so whenever you buy a house, guys, there's 2 types of agents. There's a seller's agent and there's a buyer's agent. Each agent owes you something in California that's called fiduciary duty. That's a law. And fiduciary duty is that the agent has to have your best interest first before anybody else's best interest, before the agent's best interest, before the seller's best interest. So you as the buyer, they have to protect your best interest. So that's how agency works. So wherever you're buying a house, you want to make sure that you choose an agent that's going to have your best interest. Okay, what's the next? All right, so the first step is home loan pre-approval. So right now you're gathering a lot of information about buying a home, which is great. It's going to help you make better decisions. And the first step is getting approved for a loan. So let's get into that. This is going back to what we were talking about, interest rates. So in the 1970s, interest rates were in the 8% range. In the 1980s, 12% range. In the 1990s, 8% range. 2000 and 2010, it was 6%, 6.29%. And then on average, over the last 10 years, 2010 to now, it's been about almost 4%, okay? So between 2010 and 2020, it averaged about 4%, 4 and some change. This year brought it down a little bit. So if you look here, interest rates have been the lowest they've ever been. So I think it's a blessing for anyone looking to buy a home, for sure. All right, let's get into the next one. Yeah, projections, Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors, everyone's projecting that interest rates are going to go up, right? Because they're just like, man, there's no way they're going to stay this low. So far, they're a little bit off. They're saying 2.93%. It's like, nah, we're below that in the second quarter. The third quarter, they're saying 3%. No, we're below that. So I think all these associations are just like, there's no way that they could stay this low. So they're projecting that they're going to go up. Okay, let's go on to the next one. There's 3 different types of lenders. So when you go and buy a house, guys, there's 3 different types of lenders that could help you buy a home. Okay, there's a mortgage broker, large direct lenders, private direct lenders. So all 3 are okay. All 3 are going to, get the job done. But let's talk a little bit about the differences. The large direct lenders. So if you're buying, well, historically, it's been true that large direct lenders suck for the most part. But the last few years, they've gotten very competitive. Okay. If you're buying a home over $1 million, a large direct lender is probably going to beat out everybody when it comes to rates and pricing. Okay. Anything under, private direct lenders and mortgage brokers are very competitive. Bank of America right now, for example, they're considered a large direct lender. Can we go to the next slide so we can see what is considered a large direct lender?
Oh.
There we go. So these are some of the large direct lenders: Wells Fargo, Navy Fed, Chase, Citibank, Bank of America, credit unions. These are companies that are going to give you the money directly. They're not going to go through a third party, or they don't have a line of credit. They're going to give you the money directly, and they're going to service the loan directly. Go back, please. So when we're talking about large direct lenders, these guys are going to give you the money directly. They have good rates and their fees are low. Sometimes they suck when it comes to just time. You know, they can't close a deal in, 14 days or 17 days or 21 days like mortgage brokers and private direct lenders. Okay. But they have good programs. Like Bank of America has a program right now. They're giving first-time buyers $17,500 for free, which is crazy. And again, like I started off the conversation, this is a game, meaning ownership, home ownership, real estate. It's a game. You just got to know the rules. So some of the rules is knowing also, I guess, who's doing what, knowing which banks are offering what deals. And that's a heck of a deal. If a bank's telling you, hey, I'm going to give you $17,500. The interest rate is going to be 2.5%. I'm not going to charge you mortgage insurance. Why wouldn't you go with that? I mean, that's a fantastic deal. Bank of America has that deal right now. And I just think it's a slam dunk deal. Now, rates, let's talk about the differences. Rates, they're all going to be relatively about the same. Guidelines, that's the thing, is large direct lenders usually a little bit stricter with guidelines. Fees, sometimes they're all about the same, except large direct lenders are usually cheaper. When you deal with brokers, they might have higher fees. Communication, depending on which large direct lender, you might only be able to talk to them Monday through Friday, 9 to 5, which isn't cool. With private direct lender and brokers, you can reach them, night, day, weekend. It goes a long way. And then the only last thing I'll mention about this is when you deal with a broker, they're brokering the transaction, meaning they're not giving you the money directly. Therefore, sometimes if you need it in a rush, or if it's a difficult transaction, they're just a middleman. They're just like telling you like, hey, look at, like, there's nothing I could do personally because I don't even work in that bank. I'm just brokering their transaction. So that kind of sucks if you get into that type of situation. So long story short, these are 3 different types of brokers out there, or 3 different types of lenders. I've worked with hundreds of lenders in my career, and I work with about 7 different ones right now. So depending on your situation, if you need a lender, let me know, and then I'll introduce you to someone that could fit your needs. All right, let's look at the next one, please. So what's included in a mortgage payment? There's 4 parts. There's principal, interest, taxes, and insurance. So those 4 parts are included. So when you make a payment, you're paying down the principal of what you owe on the property. You're paying interest. That's what they're charging you to borrow the money. And then you're paying off the real estate taxes. That's what the county's charging you to own that piece of real estate. And then you're paying off insurance. So all 4, and by the way, insurance means like fire insurance. So if it like burns down, or sometimes when there's, plumbing issues like big leaks or natural disasters, that's covered. But except, it doesn't include earthquake insurance. So that's not included. That's a separate insurance. So anyways, with your monthly mortgage payment, if you get a 30-year fixed, a 15-year fixed, a 20-year fixed loan, it's going to include these 4 components in one payment. At any point, by the way, you could ask a question, you can unmute yourself, or you could just throw it in the chat. All right. Cost of financing a home. This is important, right? So what am I going to be paying when I buy a home? Well, the purchase price, that's a price tag. The down payment. So the down payment is just a percentage. You know, if you're VA, it's zero down. There's some programs right now with different counties, down payment assistance programs where you pay zero down. Now, just know, for the most part, except for VA, the more money you borrow, usually the more expensive the closing costs are. Okay, so I repeat that. The more money you borrow, usually the more expensive the closing costs are. So the traditional, most buyers right now in this market are buying their first home with about, on average, 7% down. Okay, because some buyers, very few buyers are putting 20% down. Some other buyers are paying 10% down. And then a ton of buyers are putting 5% down or 3% down, and then 3.5% as well. So that's the down payment, okay? And then the bank puts in the rest. They put in the difference from whatever you put down and the purchase price. Interest, that's the cost of borrowing money. Someone's asking, does the rate change with the down payment? That's a great question. Typically, no. So for example, the best rate out right now, the best lowest price rate right now is VA buyers. VA buyer could get a 2.25% to 2.5%. Also FHA buyers, they could get 2.25, 2.5, 2.75, depending on credit. And compared to a conventional buyer. So somebody who buys a property conventional 20% down, they're gonna get like a 2.875. 3%, 2.75%. So they're gonna be paying a little bit more, okay? So to answer your question, great question. No, the down payment doesn't directly impact your rate. What does impact your rate is your FICO score, which we'll go over in a bit. But your FICO score, the higher your rate, the better credit, the better interest rate you get. The lower, the higher. Another question, what if you plan to put down 15 to 20%, but you have a jumbo loan? Awesome. So if you're gonna go jumbo, what I would do is 20%, because at that point, once you get into jumbo products, the bank wants to feel protected, right? And since you're not, what I mentioned earlier was government-backed loans, FHA, VA, those are government-backed loans. So those interest rates are just like dumb low. When you go jumbo, or you're buying a bigger property above 750,000, I think, as far as the loan amount, that's considered jumbo, then the bank wants to feel protected because the federal government isn't backing them. So once you get to put down 20% or 25%, then your rate does drop. Okay, they do give you a cut on the break, on the rate. So 15% down, you're still gonna pay mortgage insurance if you put 15% down, and then the rate's gonna be a little bit up. So if you do have the 20%, then probably go with that. And I don't know what the median price home in Sacramento is, but I don't know if it's higher than, I don't think it's higher than San Diego. But yeah, I would say if you're doing jumbo, might as well just put the 20% down.
Well, Terry, and if I may, I actually
Yes.
just ran into a similar situation where my client was putting 20% down on a $715,000 purchase, and they were getting a 2.75. And as soon as they went up to 25% down, that's exactly what you said. It went down to 2.65. So it did drop a little bit, but it went from 20% to 25%.
Yeah. And by the way, and thank you for that information. And I'll give you one more pointer on that, Rudy. If you're buying jumbo and you have 20% down, you could go to a special bank called a relationship bank. Once you go to a relationship bank, what they usually offer you is they say, hey, we're gonna give you this interest rate. You need to put down 20% down minimum. And if you bring in $50,000, right, for us to manage your money, then what happens there is they drop the rate from, you know, on a jumbo right now, 2.625, 2.75, 2.8. They drop it down to like 2.25 or 2.325, depending on the bank. So you get a significant discount if you give them some money to invest for you, you know, money management. You could throw it into like the S&P 500 or something super conservative that's not going to get you in trouble. So if you have a 401k, that qualifies. So you basically say, okay, look it, before, you know, so-and-so was managing my 401k. Now you get to manage my 401k that has 50,000 or 100,000 or whatever. And now you just get a big, huge discount on the rate. So if you're going that route, then that's kind of like a trick where you can get like a really good rate just by having somebody else manage your 401k. Cool, my pleasure. All right, so closing costs. Let's get into closing costs. So closing costs are fees and expenses paid by the buyer to close the deal. So closing costs do not go towards the home loan or the, you know, it's just fees. Okay, so some closing costs may include paying the escrow company their fee, the title company, the lender fees, real estate fees, if any. Usually on the buyer side, you don't really pay a commission. You might pay a fee, a transaction fee of, you know, anywhere, depending on the area, but anywhere between 500 to 800 bucks. Notary fees, you know, they might charge for the loan docs a couple $100 as a fee, HOA fees. So usually your total fees are somewhere around 2% to 3% of the purchase price. So besides your down payment, you need to have about 2 to 3% of the purchase price to pay your fees. Okay. So if you buy $1 million property and you come in with, you know, 10% down, that's 100,000, you're going to need another 2 to 3%, probably not that much. You're probably going to need another 15,000 for your closing costs. So you need 115,000 in that scenario. Okay. All right, let's go on to the next one. And again, any time you can ask me questions. All right, so step 2, once you're approved, okay, so the first thing is the approval process, which, by the way, you could talk to a lender. It's absolutely free, doesn't cost you anything. There's no obligation. You don't have to buy a home just to get approved, okay? But anyways, you talk to a lender. The lender could tell you, hey, congratulations, you're approved. You could go buy a house. Here you go. And they give you an approval letter within a week. Or the lender might say, hey, look, based on your situation, you can't qualify right now. You need to go save X amount of dollars. You need to go fix your credit to this FICO score amount, or you need to go pay off some debt. So they'll give you a blueprint. And again, it's free. That blueprint's free. You get the blueprint, you have an idea of what you got to do, and then you go execute. Cool? All right. So once you get qualified, then this is the next step, is you meet with your preferred Lepe Tendwell real estate agent, okay? Or if you're in another area, an agent that we could refer to you that does really good business just like us. So we meet, okay, you tell us exactly what you're looking for. This is when we fill out a buyer search criteria form, and you tell us, okay, we're looking for a 3-bedroom, 2-bath, this area. And then from there, we enter all of your criteria into our powerful computer search program. And then number 3, we send you regular updated emails of listings that match all your criteria, including short sales, foreclosures, for sale by owners. And by the way, the program that we have has access to all the properties available from every single real estate company. And then after you receive those properties, then you tell us which properties you're interested in. And then we start investigating those properties for you. And we start getting you into these properties and showing you these properties in person. And then after that, you just choose which ones you like, and we do the rest. We write the offer, we do a technical analysis, and then we tell you what it's worth, and we guide you on what you should be offering on that property. Okay, we have a question. What's the average closing cost for a home in San Diego with 950 median? That's about $12,000 bucks, I would say. That's the average. And by the way, part of that is closing costs, and part of that, part of those are fees, and the other part are prepaid, they're called. So you prepay a year of your homeowner's insurance. You prepay several months of real estate taxes. And then you also prepay interest on your loan for your first payment. So some of those are actually you're prepaying. So a few $1,000s are prepaids, and then the other, let's say $9,000 of the 12,000 in this example are actual fees, lender fees, title fees, escrow fees. So, and yeah, so that's kind of how that works. All right. So anyways, once we gather your information, we go out, start looking at homes, shopping for homes, and choosing the right one. That's step 2. So step 3, we help you get the home that you want using our specialized market knowledge and leading edge technology. So this is where we go into what we just discussed, which is knowing what's happening out there in the market. Okay. So we know what appreciation looks like, right? We could tell you. You could go into the appreciation chart, please, Claudia. Right. So we know real estate and what it's done over the years, right? We know that the median price homes have been going up, and then it dropped in 2008. And then right there was up and down, up and down. By the way, guys, in 2009, 10, 11, 12, I was reaching out to so many people saying, buy a home, please buy a home. People were scared. People did not want to buy. They were saying, no, Voltaire, I'm waiting for it to drop even further. And I was like, dude, how low can it, I'm offering you a house, in a good area for 200,000. What do you mean? What do you want to buy it for? So that just kind of just goes to show you that, no matter where the market is, there's always going to be people afraid to buy, nervous to buy, which is normal, but you got to get over that hump. So anyways, so you see it drop 2008, 9, 10, 11, 12, 13, and then from there it starts going up. 14, 15, 16, 17, 18, 19, 20, 21, we're getting into, right? So right now we're at all-time highs, which is funny because I just said a few moments ago that it's the most affordable it's ever been. And why? Because interest rates are so low. And I'm buying right now. I think if somebody's offering me money at 2%, 2.5%, 3%, I'm taking that money, right? And I really believe in it. Okay, that's appreciation chart. Inventory levels, we're negative inventory, right? Let's keep going. We went over the market in a bit. This is kind of the competition where we just went over. 20% of buyers are going to be VA buyers, 40% of buyers are going to be like FHA or 3% down conventional or 5% down conventional, basically first-time buyers. And then 20% of buyers are going to be people with 20 to 30% down. So the more down payment you have, the stronger you are. Okay, and you're able to beat out other buyers that aren't as strong. And then 20% of the buyers are cash. So right now, there's a lot of money out there. There's a lot of cash buyers beating a lot of people out, okay? So that's your competition, just so you kind of get an idea of what the percentages look like. All right, what's next? Types of listings. So this is a little bit outdated. If you look at this pie, which we should fix, it's about 99% traditional sales, maybe 1%. Everything else. Sometimes there's off-market properties. So sometimes step 4, sometimes we go into our database and our network and we try to find deals off the market, see if we could get them out to you before you have to compete against 3, 5, 7 parties. All right, what's the next one? Step 5, we close your transaction quickly and with the least cost and hassle using a team sales approach. So by the way, we'll skip this part, but whoever you work with, guys, you want to make sure that they have a team. Because if your agent is a solo agent, doesn't have any support, just like I was a solo agent for many years, I did a good job for my clients because I cared, I worked hard, but the times that I was sick, the times that I was on vacation, the times that I was with my family, I wasn't able to show them those homes, or the time that I was showing homes to like other clients, you know, they didn't get the service that they're getting from us today. Today is like, you know, we're really good. So you want to work with somebody who has a team around them, a small team. Okay. All right. And the last thing we're going to go over is average escrow timeline. So the average escrow. So what is escrow? Escrow is basically a third and neutral party who does all the paperwork and holds the money. Okay, so I'll go ahead and use a basketball analogy, just because my basketball buddy's on here. It's kind of like when you play somebody one-on-one and you bet $20 who wins the game, and then you give, each of you give $20 to the fat kid because you know he ain't running nowhere, and have him hold the money, and whoever wins, you know, gets the money. So that's what escrow is a little fat kid holding the money. And escrow is in charge to make sure that at the end of the transaction, the seller gets the money and the buyer gets what the seller promised them, which is clean and clear title to the home. So escrow does the exchange at the close, okay? So whenever you hear someone say, I'm in escrow, or escrow is gonna close on this date, all that means is that your friend, whoever's telling you this, got their offer accepted, and they're going through this timeline that I'm showing you right now. I'm going to explain to you, and that they're going to get their keys as soon as escrow closes on the last day. So that's what escrow is. Okay. So day one starts when you get your offer accepted. You go out there, we look at properties, you write offers, and the seller accepts your offer. So that starts day one of escrow. So that gives you 3 days to put your earnest money deposit into escrow. And by the way, Claudia, we can update this. This should be now about $10,000, right? So by the way, your deposit, right now on average, I'm seeing 10 grand as a deposit. That's just holding your spot, holding the property for you. It's almost like when you rent a home and there's a deposit, a rental deposit. Okay, that money belongs to the tenant, doesn't belong to the landlord. The landlord holds it, but it belongs to the tenant. Same thing. When you put your deposit in, your 10 grand, that's your money. Okay, it's not the seller's money, but escrow holds your deposit. So you have 3 days to put your deposit in. By the way, your deposit could be as low as $1. Now, a seller won't accept your $1 deposit. But the lowest one I've ever done is $100 deposit. I don't know how I got that accepted for my buyer, but that's all the money the buyer had, and they got a great deal, great property. But anyways, that's deposit, 3 days. From there, 7 days. Okay, so from day 1 to day 7, the seller has that time frame to give you all disclosures, and a disclosure is statements that the sellers put in writing disclosing what's wrong with the home that they know of. They disclose to you things like if someone's passed away in the home in the last 3 years. They disclose to you whether the property is near an industrial area. They disclose to you whether there's any issues with the plumbing, electrical, roof. They disclose to you whether there's issues with the neighbors, whether the neighbors are neighborhood nuisances and are like throwing parties to 2 in the morning, every other night. So the seller legally has to disclose these things to you. They have 7 days to do it. And then from there, 10 to 17 days, that's your contingency period. So you normally have 7 to 10 days to do your inspection. And then you have 12 to 17 days to do your loan and your appraisal, okay? Which I'll go more into in a bit. So you have that time frame to actually do the inspections. Now, contingency means your right to cancel the transaction. So you have between 7 to 17 days usually to cancel the transaction. So what are the reasons so to cancel a transaction? Well, number one, your first contingency is your inspection contingency. If you feel that the property isn't in the shape that you want it to be, and you're not okay with the condition of the property, you get to cancel, you get your deposit back. Okay, there's no cancellation fee. If the property doesn't appraise, that's your appraisal contingency. You get to use that contingency and cancel because the bank isn't going to loan you what you wanted to borrow from them. The next contingency that you may have is your loan contingency. So you could, if you don't get approved for the loan, you could cancel. Okay, let's say you lose your job or something hits your credit that you didn't see before, you could cancel, get your money back. So those are your contingencies. All right. Now, on day 17, your agent's probably going to ask you, hey, today's the last day that you can cancel and get your deposit back. Are you ready to cancel? I mean, are you ready to move forward, or do you want to cancel? Then at that point, you go, yeah, I did all my inspections. I talked to my lender about my loan. The appraisal came in good. Let's just remove contingencies. Let's move forward and close the deal. Then at that point, you remove contingencies, you move forward and you close the deal. Or you say, you know what, I don't feel comfortable with the condition. I'm not going to get my loan, or the appraisal sucked. Let's just cancel and let me get my deposit back. So that's how that works. By the way, in those first 10 to 17 days, these are typically the inspections that you do as a buyer. You do the appraisal down here at the bottom. It's kind of hard to see. You have your appraisal, that's about $500. You have your physical home inspection, and we probably need to update these prices, Claudia, too. Your physical home inspection on a condo, $350. On a big house, $550, $600. And then you have your termite inspection, just to hire someone to go and check to see if there's termites and if that's going to be an issue for you. That's about $100. So all in, you're right around $1,000 in fees, money that you're never going to see again because you're paying professionals to go out there and inspect the property for you. Okay. So that's the escrow timeline, and that's our information for the night. That's does anybody have any questions about the escrow timeline at all? The process of once you find a house and you're in escrow. Okay, cool. All right.
I have a question.
Yes.
You said that the only bank that's offering the $17,500 is Bank of America?
Not the only bank, but they're offering $17,500 right now, which is a great deal. I would definitely take advantage of it. There's other banks that are offering, you know, free appraisal, or there's CalHafa that offers like, what is CalHafa offering? They're offering like 3%. That could go towards your closing costs up to a certain amount. So there's always programs available. There's a first-time buyer home program in San Diego County that gives you up to $70,000 down payment assistance, but it's not free money. You have to pay it back in the future. So there's down payment assistance that you have to pay back, and then there's grants that you don't have to pay back. The one with Bank of America, you don't have to pay back. All right. Any other questions about home ownership, real estate, the process, anything?
Somebody asked in the chat, how much is the rate for that kind of loan? I believe they're referencing that Bank of America grant.
2.5%. It's crazy.
I'm asking about the assistance program. You said they're not offering money, but you have to.
Oh yeah, yeah. Okay, great. So check this out. I love down payment assistance programs. Why do I love them? Because they're giving you a way to get into property if you don't have a down payment. And yes, you do have to pay them back. The rates are a little bit higher. Like, for example, on the $70,000 that they give you, that's a silent second, it's called, meaning you don't pay interest on it. You don't pay a mortgage on it. You don't pay nothing. So your monthly payment is super cheap. But once you do sell 5 years from now, 10 years from now, 15 years from now, then you have to pay it back. And then they charge you, I think on that deal, they charge you 3% simple interest. It's not compounded. So it's like, if they let you borrow 70,000 times 3%, that's $2,100, $2,100 per year. So over 10 years, that's $21,000 that you got to pay them back. However, in 10 years, usually your appreciation goes way up and you earn money on the property. So it's a really good deal. And then, so that's on the silent second. On the first loan, it's probably going to be like low 3% range. So again, earlier I referenced, anytime you borrow more money, it gets more expensive than borrowing less money. That's just how it works, right? Anytime you borrow money, it just costs more. But that's a great program. I like that program.
By any chance, are you allowed to actually pay it like in advance? Because I know some of the banks or things that you take money from, you're not allowed to pay it until a certain amount of time.
Great question. So that is the old system. And that's when like the market crashed. After the market crashed 2008, 2009, they changed all the rules. So the loans, you can pay them back whenever you want. There's no prepayment penalty. That's what you're referencing, prepayment penalty. So what I do for my loans, there's a trick, Ramon. I get 30-year fixed loans, but they're paid off in 23 years. And the reason why they're paid off in 23 years is if my payment is $3,000 a month, as an example, I just pay $1,500 every 2 weeks. So my bank allows me to do that, right? So even though I'm paying $3,000, I split it up in 2 payments, $1,500 every 2 weeks. And the way compound interest works is it shaves off 7 years off the 30-year loan just by doing it that way. Instead of paying $3,000 a month one time, I pay $3,000 a month, split up in 2 payments, and I paid off in 23 years instead of 30 years. And in that process, you save about $100,000 depending on how big your loan is, but you saved a lot of thousands of dollars, tens of thousands of dollars in interest by doing it that way. So there isn't a prepayment penalties anymore. Typically, they don't want to get paid within 6 months. So you have to wait like 6 months to a year just to pay them off, right? Most people aren't going to do that, but banks are in the business to make money. So they want you to pay it off over time. But if you run into extra money, you have $10,000, $15,000 extra, you can just pay off big chunks at a time if you want.
Okay, that makes sense. Thank you.
Yeah, of course, my pleasure. Thanks for asking that question.
Yeah, and actually, I have a family member that took on a silent second loan like that, and by the time I caught her 8 years later, it was up to $80,000. And I got her with my lender and took advantage of these low rates, and they actually refied and combined them together, so that way that silent loan is not just in the back collecting interest mindlessly.
That's cool. And then, so the other question I have on that, bro, is, does she have equity in her home?
Definitely.
Okay, so even though she borrowed money, she still had equity.
Yeah, this is 8 years later, and to be quite honest, I think she's got about $250,000 worth of equity.
Yeah, see, so that's why I like down payment assistance programs, just because if you can get your foot in the door, it's better to do it now than to wait. Because the longer you wait to save up more money or whatever, it's just going to cost you more because inflation, appreciation, everything just goes up. All right, what other questions do we have? All right, I think that's it. I think we're running up against our time. Thank you guys so much for joining us tonight on a Thursday night, 7:30. I know a lot of you guys are hungry. I know I'm starting to get there, but any final questions before we log off? Cool. All right, if you have any questions, reach out to your favorite Lepe Tendwell real estate agent. Ask them, to hook you up with a lender. Ask them, for a one-on-one to talk more about your specific situation, and that way we could help you guys out. Thank you guys for joining.
Thanks,
Peace
Walter.
out. Yeah, my pleasure. All right.
Thank you very much. Have a good night.
All right, thank you. You too. See you later. See you later, Rudy. See you later, Ramon. What's up, Coach? We're finishing up. We're logging off.
Hey, buddy.
What's up? Yeah, we just finished this this presentation, so